At this moment, the United States stock market is hitting all-time highs. If you only look at Wall Street, the economy appears healthy. But underneath those numbers, the physical infrastructure that powers the world is silently collapsing. Since March, dozens of energy pipelines across the globe have either caught fire or exploded, and the supply lines that keep the world running are breaking down. To understand the scale of this, consider that the global economy requires 100 million barrels of oil every single day. Because of blockades and closures around the Strait of Hormuz, between 8 and 13 million of those barrels are currently missing. This chart highlights a massive disconnect in how oil is being valued. There are currently two different prices. One is the paper price, the number you see on a computer screen for futures contracts. The other is the physical price, the amount a country actually pays to have a real barrel of oil delivered to a refinery today. If you search for the price of oil right now, you'll likely see a figure around $100. But for those who need physical delivery within the next 30 days, that same barrel costs over $130. That $35 spread is the largest gap ever recorded in history. This means the stock market is currently trading on a set of assumptions that do not match the physical reality on the ocean. By following the paper price, the American public is seeing a calm market that effectively hides the largest supply shock of the modern era. Data suggests this price gap is being managed through the markets. Since the crisis began, traders have shorted the oil market by hundreds of millions of dollars, exactly 20 minutes before official announcements claimed the situation was under control. It is a recurring pattern of massive bets appearing just before a burst of political optimism pushes paper prices lower. This relies on the mechanics of a short position. When an investor shorts oil futures, they are selling a promise to deliver oil at a later date. Eventually, when that contract expires, the seller is legally obligated to either buy back the contract or deliver the physical barrels they promised. But the physical supply needed to back those promises is hitting a wall. While the US relies on the Strategic Petroleum Reserve, those tanks were already half empty before this conflict started. We have already used a significant portion of our emergency savings. If you add up the emergency stockpiles of the US, Canada, and Venezuela, the world only has a buffer of about 2.8 million barrels a day. That is not enough to cover a daily shortage that ranges as high as 13 million barrels. The paper market is effectively selling promises of oil that does not exist in the physical world. This has created a mathematical gap that can only stay hidden as long as the physical supply chain can keep up. Outside the US, the shortage is already causing major disruptions. Asian oil deliveries collapsed on April 1st. In response, the Philippines declared a national emergency as gas prices doubled, while Vietnam and Indonesia have implemented remote work policies to conserve energy. The effects are now reaching Africa and Europe. In Ethiopia and Zimbabwe, the remaining petrol is being diluted with chemicals to stretch the supply, and industrial centers across Europe are slowing down as energy costs become prohibitive. The blockade in the Strait of Hormuz also restricts the flow of natural gas, the essential raw material for producing urea fertilizer. As the data shows, fertilizer prices are climbing back toward the record highs of 2022, a change that will eventually result in higher costs at the grocery store. This physical reality is starting to affect global finance. The interest rates a government must pay to borrow money, known as bond yields, are rising across the US, the UK, and Germany. This makes it significantly more expensive for these nations to carry their existing debt. However, China's bond yields are actually falling. For the first time in 2 decades, China has lower borrowing costs than the US and Japan. This suggests that international investors are moving capital toward China as a safe haven during the crisis. Global trade and international capital are already reacting as if a major crisis is underway. The optimistic narrative currently held by the US stock market is increasingly isolated from the rest of the world. The US has been shielded from this reality by geography. It takes weeks for massive oil tankers to cross the ocean, meaning we are currently using oil that was shipped before the blockades began. That buffer is expected to run out in mid to late April. By that point, the oil tankers that cleared the Strait of Hormuz before the closure will have reached their destinations, and the global supply chain will be empty of its pre-crisis reserves. When these paper contracts expire, buyers will demand the oil they were promised. Because there isn't enough physical supply to go around, sellers will be forced to buy real barrels at whatever the current market price is. This creates a short squeeze, where the paper price is forced to violently catch up to the physical reality. History provides a clear example of what happens next. During the Arab oil embargo of 1973, the world faced a sudden, major supply disruption. In 1973, a 7% cut in supply caused oil prices to spike by 300%. The result was double-digit inflation and a recession that lasted for years. This chart compares that history to our current situation. While the shocks of 1973 and 1990 removed about 7% of the world's supply, we are currently facing a disruption of 15 to 20%. When physical shortages force paper prices to catch up, inflation typically follows. This puts the Federal Reserve in a position where they cannot cut interest rates without risking further price spikes, forcing the government to pay more to service its massive debt, while the deficit continues to grow. If you want to understand the hidden power behind money and the global economy, make sure to like this video and subscribe to the channel Dollar Logic USA. The United States economy is running on fumes, and the people managing the money are actively hiding the fuel gauge. Publicly, the narrative is one of stability. The stock market is near all-time highs, and official reports suggest a perfect economic landing. This scale reveals the disconnect. While digital search engines show oil at a manageable $100 a barrel, the actual cash price to have a real barrel delivered today is over $130. This $35 gap stands as the widest spread ever recorded in the history of commodity markets. This discrepancy provides evidence that the global financial system is obscuring a supply reality that has already begun to affect the physical world. The lower price is known as Brent futures. It functions as a psychological tool used by Wall Street to project a sense of market stability. The physical price is called dated Brent. This represents the actual cash required to load oil onto a ship for immediate delivery to a refinery. This chart shows that for 20 years, these two prices move together, rarely drifting more than a few dollars apart. That historical correlation has now vanished. While oil prices briefly diverged during the 2020 lockdowns, that was due to a total collapse in demand. The current gap indicates a supply emergency. According to data from JP Morgan, the final tanker to clear the Strait of Hormuz before its closure reached its destination on April 20th. This date marks the moment the global supply chain fully exhausted its pre-crisis inventory. The shortage is driven by a physical bottleneck. The Strait of Hormuz is effectively closed, and energy pipelines across the globe are experiencing active failures. This has removed between 8 and 13 million barrels of oil from the global market every single day. This deficit represents double the entire capacity of the United States Strategic Petroleum Reserve over the course of the current conflict. The impact is visible in Asia and Africa, where gas prices in the Philippines doubled overnight, and fishing fleets in Thailand have been forced to shut down due to fuel costs. These localized disruptions in Asia and Africa represent the first stage of a supply chain disruption moving toward the American market. Why does the paper price remain low, projecting an illusion of stability, while the actual physical supply is disappearing? Massive financial entities are currently holding short positions, issuing paper contracts for oil they do not actually possess. This floods the market with paper promises to deliver oil at $100, temporarily capping the price. When these contracts expire, the sellers are legally required to buy back that oil at the true market rate. Because physical atoms cannot be printed, this forced buying will trigger a short squeeze that aligns the paper price with the physical reality. The crisis extends to food production. The same trade routes that carry oil also supply the natural gas used to manufacture agricultural fertilizer. Surging fertilizer costs today indicate a significant increase in grocery and food prices over the next 6 to 12 months. This chart tracks the U.S. 10-year Treasury yield. Rising energy inflation makes it difficult for the Federal Reserve to cut rates, pushing this yield toward the 4.8% threshold, where servicing American debt becomes unsustainable. In contrast, Chinese bond yields are dropping. For the first time in 20 years, China's yields are lower than the US and UK, positioning it as a safe haven. Disrupting global oil flows was intended to isolate rival economies. Instead, the resulting inflation drives capital toward China while raising the cost of maintaining American debt. During the 1973 embargo, a 7% drop in oil supply resulted in a 52% market crash. The current global supply drop is estimated between 15 and 20%. History shows that when paper markets disagree with the physical world eventually dictates the outcome. Wall Street is standing on the beach, watching a rising market while the tide recedes. The economic shift is already in motion. To understand the forces shifting the global economy, hit the like button and subscribe to Dollar Logic USA.